Ladies and gentlemen, good morning. Welcome at quarterly results of PGE. Hosts of today's meetings are Mr. Krzysztof Kilian, President and CEO, and Mr. Wojciech Ostrowski, CFO of the company. My name is Przemek Wasilewski. I'm Head of Investor Relations. Before we start, as usually, a couple of technical issues. We are sitting here in front of a group of Polish investors and analysts, but the meeting is broadcasted via internet to anyone willing to watch it. After a short presentation, we will be ready to answer your questions. If you are on site, this is pretty simple. You ask a question, we give you an answer. For internet viewers, it's a bit more complex. You need to send an email to an usual address, pgeresults@gkpge.pl, or simpler, use a special form on transmission site. So we shall begin, Mr. President.
Ladies and gentlemen, it's a pleasure to see you again here in Warsaw at our offices, PGE House. I don't know if you like it. Welcome. We have met here to discuss our operating and financial results for the first 3 months of 2013. Please let me begin with a general overview of the market environment of Q1 highlights. Afterwards, my colleague Wojciech Ostrowski, PGE's CFO, will take you through the details of our financial results. The first 3 months of 2013 have confirmed earlier expectations of the overall market conditions, including the general state of the economy, GDP growth, and looking a bit deeper, industrial output and electricity demand. Recently announced GDP growth of 0.4 percentage point year-on-year compared to last year's growth of 3.6 percentage point emphasizes the scale of the economic slowdown. If you look at the industrial output figures and electricity consumption, it's even more pronounced. Both metrics shrink by 2 percentage points year-on-year, and if we take a closer look at last year's figures, we see the maintaining positive economic growth is not sufficient. Sorry, this is my telephone.
Somebody would like to join us.
Yes. From Warsaw Autumn. This is very, far away from your job. Warsaw Autumn, this is music festival of contemporary music. Doesn't matter. You may recall that 2012 full-year figures for the electricity consumption amounted to a drop of 0.6%, while now we see a drop of 1.8% on quarterly basis. However, please bear in mind that seasonal base effect. Previous year, 2012, was a leap year with 1 additional day in February. This can explain even 1 percentage point of the year-on-year difference, but in any case, it barely improves the picture. The slide 4. We have stayed well prepared for the market changes, and we again deliver solid financials and a healthy balance sheet. Our reported EBITDA margin amounted to 29% and still put us among the most profitable utilities in Europe and on the absolute top in Poland. Our quarterly EBITDA of 2.3 billion zloty is actually the highest of all Polish listed companies. However, reported EBITDA was in fact lower than last year by 15%, or about 390 million, mostly due to the external factors. In 2013, a third phase of carbon allocation has begun, resulting in the decline of free carbon allocation, an approximate impact of 150 million on our result. And lower electricity prices and decommissioned 206 megawatt block in Turów impacted our results negatively by approximately 370 million. With over 2.5 billion of net cash at the end of the quarter, we remain least leveraged among the electricity producers in Europe. This is rarely seen these days and provides us with comfort to take optimal decisions without pressure from creditors. We would like to utilize these financial resources effectively and to the benefit of our shareholders. Let's look a bit deeper at key operational results. We have increased generation from renewable sources by 7% year-on-year after acquisition, which grew our wind capacity, even though we scaled down biomass co-firing due to the decline of profitability of this type of fuel. Conventional generation volume reached 14.3 terawatt-hours. It means 5.5 less year-on-year. This was mostly caused by already mentioned plant decommissioning of the unit in Turów, lignite plant, which explained roughly a third of the decline, and maintenance, repair, and renovation works in Bełchatów and Opole plants that impacted the results by 2 percentage points, and lower generation in gas-fired CHPs due to the lack of support and our decision to scale down this type of cogeneration. This took away approximately 0.6 percentage point of the volume. And I have already mentioned base effect of the leap year. This can explain the remaining part of the difference. Let me point out that our margin on a whole value chain has been actually much better than the power exchange prices may suggest. Generation results were partially compensated by good performance of wholesale and retail business lines. Finally, from highlights of Q1, I need to point out that as the only large utility in Poland, we managed to increase market share on the retail market. Volume of electricity sold to our end customers reached 8.9 terawatt-hours, enjoying growth of 5% year-on-year, massively surpassing market dynamics. And the next slide, please. When we met here 2 months ago to discuss 2012 results, we presented a number of actions we have started to better manage risk and to build a foundation for further growth. Now I'd like to give you an update on those initiatives. First, the strategy. We are in the process of obtaining the corporate approval for the document, and it does take some time. Within the strategy review, we, among others, reassess our investment portfolio to ensure that our capital is deployed most productively. The current dynamics of the energy market and the foreseeable outlook made us withdraw from the Opole project after detailed analysis. Given the quality and characteristics of our existing assets and portfolio of other investment options, the Opole project would not be value creative for the PGE shareholders. And third, we continue a deeper integration and consolidation within the group, which is a part of cost optimization and long-term efficiency improvements. As we outlined recently, we want a stronger integration between our business lines, better management efficiency, and improved execution. Therefore, we have launched a number of initiatives which are developing quite well. The implementation of the new operational model is expected in Q2 of this year. We are proceeding with the SAP introduction process as planned and expect to implement it in the third quarter. We are in the process of reshuffling ICT technologies and building one centrally managed shared service center. And finally, we have also begun cost optimization in the Turów complex. The project intends to fully utilize the cost reduction potential to strengthen further our cost leadership position. This project will be rolled out in other generation assets of the group. In times like today, everyone obviously presents his focus on internal efficiencies. However, only a few are able to show how their prudence is reflected in the financial results. We certainly can. I refer you to details of our accounts where you can actually see material effects of our efforts. This would be the most important facts I wanted to point out to you. Now I will hand over to Wojtek, who will take you through more details of the results. Then we'll be ready to take some questions.
Good afternoon, everybody. It's very nice to see you. I didn't expect so many people because it's the the Katowice meeting. That's very nice that you are here, not in Katowice. And as you heard from our CEO, the market situation is not the best in the history of energy in Poland. The year 2013 looks not so good as 2012. And you see on the slide number 7 the reason that the prices on spot market went down 12–13% year to year. And what is much more important, the forwards decreased over 20%. In PGE, we sold the products roughly with 11.2% less than 1 year ago. It means from 205 Polish zloty, the price decreased to 182. The impact to the result was partially offset by decrease of the prices in commodities. You see the hard coal decrease 13%, and additionally by decrease of the quite big decrease of the CO2 allowance price, almost 40%. But additionally, regarding the prices, it's not just the impact of the cost side, but the lower demand, as was mentioned before, and the same increase of the renewable production, mostly based on wind in Poland. On the next slide, that regarding operational data, you see that the production decreased 5%, and it was roughly the same 5% in lignite and 5% in hard coal. The reason of the lignite decreased production was just announced that it was related to the Turów and the bigger works in Bełchatów. But regarding hard coal, really it was related to the generation optimization, which we do, because in some hours during the day, in off-peak hours, sometimes it not make sense to produce based on hard coal. Regarding the combined heat and power plants, the decrease was mostly in gas. It was the same connected with the we can say political situation where the legislation regarding yellow certificates are not valid this year. And in some cases, it was not profitable to produce based on gas. What for us is very important is the increase of the sales that we, as probably one of these big energy companies in Poland, we increase our sales, the wholesale 11% and retail 5%. When the market dropped, as was mentioned, 1.8% this time. That in this case we increase our market share in retail. On the next slide, some short financial information that sales some small decrease, that 1% year to year. EBITDA 15%, which was the same said before. EBIT 21% and net profit 25% less than last year. And this drop was connected with the generation segment, mostly because of decrease of prices. Additionally, in generation, lack of certificates and lower price of green certificates. But from other side, the certificates was fully offset by a lower cost of certificates in retail. That from this perspective, the group didn't lose money in comparison to last year. and additional cost of CO2 close to 150 million in comparison to last year. What is very good from our perspective is still the EBITDA margin close to 30% and net debt minus 0.39. Which give us the quite good position currently on the market. On the next slide, you see the confirmation that last years, 3 years, we keep roughly the income over 7 billion, EBITDA over 2 billion, and we think that it is a very good level of results during these years. Obviously, this decrease of EBITDA year to year, 15%, is connected with the market situation, what we've just informed you the reason. The confirmation for this, the same you can see on the next slide 11, with the more detailed information about the results of segments. And this decrease over 800 million results in generation, in conventional generation, was half roughly offsetted by wholesale and retail results. And this is really connected to the market. It means that the prices the decrease of the prices slightly increased the margin of the wholesale, and the decrease of the price of certificates increased the results of retail. It means that when we have the full chain, we had the opportunity to cover partially this gap. Regarding renewables, we have roughly the same result as 1 year ago, slightly better wind lag, as we can say, and slightly worse water lag, the same issue of price of green certificates. Distribution over 5% better year to year, lower volume but better tariffs and the cost lower than last year. One of these costs is the lower the transmission cost as well. And I think that what we can do internally, it is what was announced by our CEO. It means that focus on costs, what you can see on the slide number 12. You know that we provide some efficiency program. We will make it deeper at this moment in Turów and later on in another localization as well. And we did everything according to the plan and maybe slightly better. But what is more important, I think, and you can see on this slide, that the cost, I think that probably first time in our history, it means 5 years, of the PGE decrease quarter to quarter. That I think that this cost discipline, the same, give us opportunity to keep these results on this level, which we have. Some stop of the increase in employment costs and not increase in external services, because very often in such efficiency program we see that the employment costs are going down, but external services are going up and overlap this decrease. And as you see, that this decrease was in all lines, and more detailed information you have in attachments. Line by line you can compare, and we think that this is the good point for next step to make this cost reduction deeper. Thank you very much, and I give the voice to Przemek.
Thank you. So as usually, time for questions. Anyone on site can use their handicap and ask a question first.
Paweł Puchalski, Dom Maklerski bez WBK, witam. Few questions. First one on hedging. What is the volume or percentage, if you prefer, of your hedging for 2014. The other one is on volumes in distribution. We know that your volumes fell by 2% year on year. I would like to know which segment fell at the strongest pace and which was the least affected. And that's it for the moment.
Right.
And that regarding hedging is answer as usually that we we can't say really where we are. I can say that for this year is almost covered, and we started the sales for 2014 and some small sales for 2015, but sorry, we can say the percentage of our sales. Regarding distribution, this decrease was roughly the same as the whole market, and the biggest was in big clients, it means tariff A, and the smaller it was in tariff C and G. But I think that the 80% from this decrease was tariff A, it means big clients. It means not so the same, the least margins than from this bigger one.
Thank you.
Tomasz Krukowski, Deutsche Bank. Three questions, if I may. The first one refers to the nature of LTC compensation which you booked in the first quarter, because I was surprised to see something. I thought that LTC compensation will no longer be exist. If you could give some color on that and maybe some guidance what we should expect going forward.
Regarding LTCs, I think that somebody who has the good knowledge about energy business and about this legislation could expect something, because obviously we mentioned that 2013 shouldn't be the long-term contracts, but at the end of the year we did some recalculation regarding the lower prices, which partially covered this reserve which we did for the Szczecin, our power plant. And currently this is the same reason, that the low prices on the market gave us the opportunity to use still the LTC legislation. And if this level will be on the same situation as today, probably it will last next 2 years. But the question is about the level of prices. For this year, we can say that if nothing changed from the price perspective, it shouldn't be something over 500 million.
But from the other side, to slaves us on duty to sell all electricity through the electricity exchange. It creates some problems for us, but it's a duty described on the law.
And from other side, this is just our duty for today, that we need to sell this 85%, and another players on the market will have the necessity to sell just 15%.
Thank you for clarifying this. My next question refers to the margins in wholesale and energy sales business, because those margins are much higher than it used to be. And what should we expect? I mean, should we expect that finally we start giving some benefits of the lower wholesale and certificates prices to the clients? What's your client's position right now and expectations?
I think that this moment is difficult to predict. It is something what is possible, that this decrease could be passed to the final customers. The tariffs for this year are just till the end of June. not for whole year as it was usually. But from other side, the same, we can expect the increase of the prices of the green certificates because it's quite big pressure that the governmental bodies should do something with this. This moment, in some cases, the owners of renewables production assets has a problem with profitability and repayment of credits. Therefore, I think that probably they will tackle this problem, but if fully, that we will see. It's difficult to predict.
But do you see your clients asking about lower prices?
As usually, but the big clients, it means tariff A, is quite big, I think, the tough fight on the market for this client, and the prices are absolutely lower than it was 1 year ago. Obviously, we shouldn't say that the decrease is the same percentage as decrease in wholesale market, therefore this additional margin in sales, but the pressure is quite big.
Thank you.
But it was the same in the results of first quarter, partially.
And finally, my last question refers to cancelled Opole project. And actually, if you could give some color on your contractual obligations, I mean, whether the contracts which you have signed with the contractors, are those contracts already dissolved? Or maybe if you decide at some point to return to this project, you can continue with those contractors, or maybe you will need to start from the beginning the procurement procedures?
As it was mentioned in our communication to the market, it would not create value for our shareholders, and there is nothing to add at this moment. If there will be new information, we will give you an update immediately.
Yeah, but I'm referring to a hypothetical situation. Let's assume that base load right now is miraculously at 200 and the project's across profitable. So do you have a possibility to sit down with the contractors and start the project, or you need to start procurement procedures?
We announced in our communications that it would not create value for our shareholders. If anything happened in today or tomorrow, we will update you.
Fair enough, thank you.
Okay, now let's give a chance to online viewers. First question comes from Igor Kuzmin of Morgan Stanley. What average wholesale realized price does the company expect in Q2 to Q4 if this would be lower compared to Q1? And if yes, what level of reduction can be expected?
I think that this is the question to somebody over us. What could be the prices? What we see today, that the prices stopped on some level, but in reality, in first quarter, these prices slightly went down during the first quarter, and this moment they stopped on this lower level. It means that probably the prices, if no up, if they will keep the same level, could be slightly lower than in Q1. But what will be on the market, I think it will be good to know.
Then question from Filip Gottschalk of Exane. What's your view on the Polish hard coal market? Do you see further downside pressure on hard coal prices? And what average cost of hard coal do you expect for a year?
Yes, this is, I think, that the same situation as I answered regarding our clients, the big clients from Tariff A, that they put the big pressure on us, and we put big pressure to the commodities producers and to the hard coal producers, and the prices obviously will go down. We are not talking about some huge decrease, but we see this moment that this decrease, what was on the slide number 7, is probable.
Then question from Patrick Hummel of UBS. When will the strategy update happen?
It depends on our supervisory board. So we still discuss strategy with our supervisory board. When we will be ready, so immediately we would like to inform you and to share our view how we could organize ourselves on the market, inside, etc., etc. But until the decision shouldn't be taken by supervisory board, it's hard to tell about details and how it is constructed.
Then series of regulatory questions. Philip of Exane again. What growth can we expect in distribution segment in the years ahead? Do you see any downward pressure from low interest rates on the allowed return?
Yes, I think that the issue is that in the years maybe 1.5 years, we should see some increase in distribution, but not so big as we expected, we can say 1 year ago. In these times, we said that this increase should be in a low double digit, it means maybe 11, 12%. This moment, with the decrease of WACC, probably this yearly increase should be slightly lower.
And then could you give us an update on the progress of the renewables reform in Poland and your feeling on the impact of your lobbying efforts?
We are not lobbying. We are acting on this market, so that's all. So all depends on the government and regulatory body and the parliament. So we communicate to all these bodies all the time. We share our with the government, with member of the parliament, our vision how the market should be constructed, of course, from our perspective. That's all. So we still wait for the solution in the parliament. Almost ready, as we know, in the parliament. So, but we don't have such a power to push forward this work or to this job in the parliament.
And Patrick Hummel again, can you give us more color on the discussion about capacity payments in Poland and your view on this?
This moment, this is just, I think, that the first ideas in the sky. We don't know about some realistic attitude to capacity payment still, but idea appeared.
And then questions from Teresa Schinwald of Raiffeisen. When the government would repair the missing obligation of retail companies to buy color certificates?
Once again,
when the government would repair the missing obligation of retail companies to buy certificates of origin?
So it's better to ask government.
For us, as soon as possible.
And what's your outlook on the tariff changes, especially for G tariff as wholesale prices decline?
I think that for current situation, we don't expect any increase. That we are expecting that it will be flat level.
And do we have any questions on site? Okay, as we are one of few hundred companies reporting today, I know that you have other meetings following. So if you have obviously any questions, just call or email us. We'll be very glad to answer. Thank you very much. We'll see you at the end of August. Bye.
Thank you very much.
Thank you. Dziękujemy.